Assalamualaikum warahmatullahi taala wabarakatuh. This is the video lecture for topic 1, that is master budget. Budget is actually for individual. This is something very common. We as a human, we sometimes have our own personal budget. We calculate how much we actually earn and what are our expenses, and as a residual of it, we will keep it as our saving. However, for manufacturing company, the budget is much more complicated, and we call it as master budget. And for manufacturing company, the master budget can be divided into two main parts. The first one is what we call as operating budget, and the second part is about financial budget. Operating budget itself actually is very comprehensive, and it comprises several other things. For example, like revenue budget, production budget, ending inventory budget, direct material cost budget, direct manufacturing labor cost budget, manufacturing overhead cost budget, cost of goods sold budget, and many more. And for the purpose of this course, I mean that in this course we will just cover up to cost of goods sold budget, that is schedule 7 in the operating budget in the master budget itself. Okay, alright, other things that we need to know in the preparation of master budget in a manufacturing company. Master budget, once we prepare the master budget, it must be always aligned with the strategy of the business. So what does it mean by the strategy? Strategy actually we refers to how basically the firm's match between its capabilities and opportunities. So basically firms need to align with all of these things, need to integrate between capabilities and opportunities for them to be successful. So as I said before, that the preparation of the budget also should consider the strategy outlined by the firms. Other than that, in regards to master budget, what basically firms need master budget is that firm need master budget as a tools of planning tools and control in the firms. So planning means that they can use master budget if they want to, because firms need to plan about the production, about the previous direct material that they have, about the costing of the material that they want to buy. So all of this information they can get from the budget itself for the planning purpose, as well as for the control in terms of, for example, they want to look at the measurement of each of the department in the company or subunit in the company itself. Okay, budget also can be used as a communication tools between each of the department or among the subunit in the company. Alright, that's all for this very brief information in regards to master budget. After this, we will look at the questions for XYZ Corporation, and we will also have we'll also learn about one of the questions, one of the long tutorial questions later on. Okay, that's all. I hope you Alright, Assalamualaikum warahmatullahi taala wabarakatuh, and hello to all of you. I'm Dr. Aisha. This is the questions regarding master budget for chapter 1, and we are going to prepare XYZ Furniture operating budget for the year 2017, and we will do it up to the cost of goods sold budget, that is schedule 7. So we are going to do schedule 1 till schedule 7 using this question. Okay, now we're going to read the question together, and I will explain how the answer should look like and how we can get the answer to be like that. Alright, XYZ Furniture sells 2 models of granite top coffee tables. Okay, so coffee tables, normally we use, granite on top to make it more prettier and easier for us to clean, because it normally uses a very smooth, it has a very smooth surface. And these 2 model, they call it as casual and deluxe. Revenue unrelated to sales, such as interest income is 0. So this information suggests that XYZ's furniture only receive revenue in the forms of sales, not from other sources such as interest income or etc. Okay, other information given: work in process inventory is negligible and is ignored, so we assume that there's no work in process inventory. Direct materials inventory and finished good inventory are costed using the first in first out FIFO method. Okay, so the products or the items that we bought first, the inventory that we bought at the beginning, we are going to use that first before the later inventory. The unit cost of direct materials purchased and unit cost of finished goods sold remain unchanged throughout each budget year, but can change from year to year. Okay, so the unit cost of direct material purchase, okay, because we have direct material, direct labor and overhead. So normally direct material used in the production of the table. Based on this information, it says that this cost remain unchanged throughout each budget year, but can change from year to year. From means that if the cost one in this year might be different than compared to the cost of the same direct material that we bought last year. There are two types of direct material: red teak and granite slabs. So red teak is in Malay we call it as kayu jati, and this is one kind of hardwood, and it is normally quite expensive and been used extensively in manufacturing furniture. Granites, as I said before, is normally used on top of the table. The direct material costs are variable with respect to units of output. Okay, so the direct material cost, it varies. It will be change according to the number of output, that is the coffee tables that has been produced by their company. Direct manufacturing labor workers are hired on an hourly basis and no overtime is worked. There are two cost drivers for manufacturing overhead costs. Number one is direct manufacturing labor hours and setup labor hours. So there are two cost drivers here for manufacturing overhead costs, and two manufacturing overhead cost pools. They call it as manufacturing operations overhead and machine setup overhead. So as we can see here, setup labor hours is very much related to machine setup overhead. Direct manufacturing labor hours is actually related to manufacturing operation overhead. Okay, we are going to look at this in more detail in the calculation part on how it works basically. Okay, now we continue with our questions. Alright, direct manufacturing labor hours is the cost driver for the variable portion of manufacturing operations overhead. Okay, so this is direct manufacturing labor hours. Okay, so we already know that in the manufacturing we have direct material, direct labor. Alright, so this is the one that it mean by direct labor. Okay, it's the cost driver for the variable portion of manufacturing operations overhead. The fixed component of manufacturing operations overhead is tied to the manufacturing capacity of 300,000 direct manufacturing labor hours that XYZ has planned for 2017. Setup labor hours are the cost driver for the variable portion of machine setup overhead. The fixed components of machine setup overhead is tied to the setup capacity of 15,000 setup labor hours that XYZ has planned for 2017. So this is basically information related to, you know, like the fixed component of machine setup overhead, the fixed component of manufacturing operation overhead. Okay, we're going to use all of this information in our calculation later on. For computing inventoriable costs, XYZ allocates all, means that both variable and fixed manufacturing operations overhead costs using direct manufacturing labor hours, and machine setup overhead costs using setup labor hours. Okay, other information includes non-manufacturing costs, consists of product design, marketing, and distribution costs. All product design costs are fixed costs for 2017. The variable components of marketing costs is the 6.5% of the sales commission and revenue paid to salesperson. The variable portion of distribution cost varies with the cubic feet of tables sold and shipped. Okay. In regards to this question on non-manufacturing costs, which they talk about marketing and distribution costs, because we only cover from Schedule 1 to Schedule 7 of Master Budget, we are not going to use this information, given that this information normally will be used for Schedule 8, Schedule 9, okay, in the operating budget for the purpose of marketing cost budget or distribution cost budget. Okay. We continue with our questions. The following data are available for 2017 budget. Alright, so here is the information, the content of each product unit. Red tick is for casual granite table, is around 12 board feet. For deluxe, they also use 12 board feet. Okay, for granite about 6 square feet. For deluxe here is 8 square feet. Direct manufacturing labor is 4 hours for casual and 6 hours for deluxe. In regards to the products, okay, the expected sales in unit is 50,000 for casual, 10,000 for deluxe. Selling price is 600 for casual, 800 for deluxe. Target ending inventory in units for casual is 11,000 for and for deluxe is around 500. Beginning inventory 1,000 and here 500. Beginning inventory in dollars is 384,000 and 262,000. All right, now we continue with our questions. Other information given basically related to direct material, where the beginning inventory and target ending inventory for red teak is 70,000 board feet. Okay, and for granite is 60,000 square feet. This is the beginning inventory, and the target ending inventory is 80,000 board feet, and this is 20,000 square feet for granite. In order for me, you know, like it's easy for me to show where basically the figures come from, I label this table. Okay, I name it as table 1, and this information in this table I call it as table 2, and the information on direct material here I will call it as table 3. Okay, now we look at other information given. Okay, seems that we still have questions or information in regards to direct materials. Okay, red tick 7 ringgit. This is the price per board feet, and this price is same as in 2016. Granite is 10 per square foot, and it is same as in 2016. This is the price for red teak and granite. And for direct manufacturing labor is about 20 ringgit per hour. Okay, all right, now we look at other information given is basically in regards to the estimation by managers. Okay, so this is some collection of additional information given. Okay, the detail of the information on manufacturing operation overhead costs is used in Schedule 5, as well as the machine setup overhead costs in Schedule 5 are based on the manager's estimation, and these figures are actually given by the managers. So if we are going to prepare the Schedule 5, and in Schedule 5 some information over there is not actually directly provided. I mean that we didn't actually calculate it. It's based on the direct information given or based on the estimation by the managers. Okay. Other than that, XYZ also managers forecast the following setup information for the casual and deluxe table. And as we can see here, so this are basically the information given by them. The quantity of the tables produced for casual is about 60 tables, deluxe is 10,000 tables. Number of tables to be produced per batch, 50 tables per batch, 40 tables per batch, means the number of batch they are going to produce. Number of batch here, 1 divided by 2, quantity divided by number of batch. So number of batch, 1,200 batch for casual and 250 batch for deluxe. Next, setup time per batch, 10 hours per batch and 12 hours per batch. Total setup hours, we divide number 3 with number 4. So we got here 12 hours for 12,000 hours for casual and 3,000 hours for deluxe. And if we add this together, we can get the total hours for setup is actually 15,000. And if we want to get the setup hours per table, we can divide, like number 5, this information, divide with 1 with 60,000, then we can get 0.2 hour for casual and 0.3 hour for deluxe. So we are going to use this information, this 15,000, 0.3 hours, 0.2 hours. We're going to use this information in our budget. All right. So alright, as for this information, I will name we'll call this table as table 6. Okay, so with all of this information, we are going to prepare the budget. Alright, now we look at the revenue budget. And this is what we call as Schedule 1. As in revenue budget, we are going to calculate the total revenue here. And obviously, once we want to calculate the revenue, we have to know the number of units that we can sell as well as the selling price. Okay, so as you can see here, number of units is 50,000 and 10,000. We can get all of this information from table 2 that I already marked before, as well as the selling price respectively are 600 and 800 respectively. Now we look at the table 2 from the questions that we receive. Okay, so here is the table 2, and as you can see, the expected unit sales in units 50,000 and 10,000, and here are basically the price, and we just put it here in the budget in the Schedule 1, and we times this 50,000 with 600, we can get this figure, and this is the total figure, that is 38 million. Alright, now we are going to look at the production budget. So as in the production budget, we calculate it in unit. Okay, as this is what we call as Schedule 2. So for production budget, we start with budgeted sales in unit as in Schedule 1, that is 50,000 and 10,000. And basically this information also from table 2 that has been given before in the question section. We have to add target ending finished good inventory 11,500 here. Total required unit, we add both, and we deduct with beginning finished good inventory of 1,500 here, and we can find here after we calculate the units of finished good to be produced. It means that the quantity of the products that we are going to produce in units is basically 60,000 for casual and 10,000 for deluxe. And the information in regards to ending finished good inventory here, as well as the finished good inventory here, I got it from table 2, and if you get back to our table 2 here, okay, here is the information that has been given. Okay, so you just put it in the production budget schedule to table, and you can get this figure basically. Alright, now we move to schedule 3A, where we are going to prepare the direct material usage budget. Okay, so in this part, we're going to look at the physical units budget. And in this part, we're going to look at the direct materials required for casual, as well as the direct materials required for deluxe table. Okay, so as for here, we can see here is the calculation: 60,000 units times with 12 board feet for red teak and 6 square feet for granite. So where actually we can get this 60,000 for casual and 10,000 for deluxe? This is actually from schedule 2. Okay, schedule 2 before. Alright, so here 60,000 and 10,000 here. This is the information that we use, means that we already know the number of unit of production we need to produce is 60,000 for casual and 10,000 for deluxe. So this information we use here for our calculation of physical unit budget for direct material. Okay, so times with 12 board feet and 6 square feet, and this is also 12 board feet and 6 square feet. And this information in regards to 12 the quantity being used for casual and deluxe here, actually I refer to the information in table 1. So we get back to our table 1 in the questions. Okay, so alright, so here is the table 1. Alright, so this information is 12 board feet for casual, for red teak, and also for granite is 6, and this one is 8 for deluxe. Okay, alright, so this is the information that we use. So the total quantity of direct material to be used, we have to add both together, and we can get this figure. Okay, so this is the schedule 3A for direct material usage budget in quantity. And okay, this part of calculation is actually showing you that the number, you know, like a company need 840,000 of board feet of the red teak and 440,000 square feet of granite. However, we still don't know this value in monetary terms, so we have to calculate, you know, the cost budget, okay, for all the items that we used before, and this is also a part of the table in 3A basically. Okay, so we're going to look at the cost budget calculation for both red teaks and granite. Alright, so here is as I said before, the part of 3A tables that is on direct material usage budget in quantity and dollars. So now we are going to calculate in the form of monetary, because before this we calculate in terms of the unit, I mean that physical unit budget. So we basically need 840,000 of board feet of the red teak and 440,000 of square feet of the granite. So for the cost budget, we start with the beginning direct material inventory, means that whatever that they already have in hand. Okay, so this information for red teak is 72,000 board feet times with RM7 per board feet, and for granite is 60,000 square feet times 10 ringgit per square feet. And this information on the beginning direct material inventory, I get it from table 3. Okay, we can have a look at the table 3 here. Alright, as you can see here, okay, the information on the beginning inventory is 70,000 and 60,000 respectively. Okay, and in regards to the price 7 and 10 here, we actually have to refer to table 4. Okay, right, so table 4 is here. Okay, Okay, this is table 4, and we can see here that the price is 7 and 10 respectively, same as in 2016. So basically, because this is the account that we have to, the budget we have to prepare for 2017, so regardless whether this is the obviously the beginning inventory for this year, which means it's actually the ending inventory for 2016, so we can use for 2016 and 2017, we can use this figure given by the question, okay, because the price is basically similar. Okay, so the red tick, we times 70,000 baud feet times with 7 ringgit, and we can get here 490,000. And for granite is 60,000 square feet. This is, you know, like already materials we have in hand. Okay, and the total is 600,000 if we calculate in amount. All right, now this is what we already have. We are going to think about what additional things that we need to purchase. Okay, so sorry, I think it's a mistake here. It's not red tick, this is granite here. Okay, I'm sorry for the mistake. Red tick here, the total amount that we need is 840,000 as we calculate here. All right, basically this is the amount that we need, 840,000 baud feet. Okay, and we already have 70,000 in the direct material, so we have to deduct this 840,000, deduct with 70,000, and we have to times with the price. Okay, with the price that we get from the table 4. So same goes to granite. In granite we need 440,000. Okay, 440,000 square feet, and we already have in stock as our beginning inventory 60,000 square feet, which means we have to deduct this from our total granite that we are going to purchase, and we have to time this with the price. Okay, that is 10 ringgit per square feet. So we got all of this figure, and direct material to be used in this period, basically we need to add up all of these things, and you know, after we add this with this, we can get about 10 millions total of direct material to be used in this period. And a part of them is actually from beginning inventory, and another part of them actually from the material that the company is going to purchase. Okay, all right, now we move to schedule 3B, that is direct materials purchases budget for the year ending December 31st, 2017. Okay, so in this part, we are going to calculate, you know, like the purchases that we need to make, as well as the price that we need to pay out of the purchases. Okay, so we start with the whatever that we need to use in our production, that is basically from schedule 3A before, that is on the physical unit. Okay, we start with the physical unit here, 840,000 and 440,000. So in this 3B, start with the physical units of 840,000 and 440,000 that we get from schedule 3A. And then we add target ending inventory, and we deduct the beginning inventory, and the purchases that we need to make is actually 850,000 baud feet for red tick and 400,000 square feet for granite. So in this case, in order for us to identify accurately about the purchases that we want to make, we have to make an adjustment by adding the target ending inventory, and we have also deduct the beginning inventory, means that we consider the in and out, the information given to us. And this information related to target ending inventory and deduct with the beginning inventory, this figure, actually I get this figure from table 3 in the questions. Okay, kindly refer to the table 3. All right, now after make such adjustment, we already know that this is the amount that we have to calculate for our cost budget, that is 850,000 board feet and 400,000 square feet for granite. So for both of them, for the cost budget, we use this figure, alright, 850,000 board feet here, and times with price, that is 7 per board feet, as well as 400,000 here, okay, times with 10,000 per square feet. So direct material that we need to purchase for this period of 2017 is basically around 9,950,000. And as for the price, you know, like 7 and 10, we can get this from table 4 from the questions that given to us. Okay, all right, so it is here basically the price. So regardless, although we are doing this calculation for 2017, but the price is still the same, okay, in 2016 or 2017 we can use the figure because the price is similar. Okay, now we look at schedule 4, direct manufacturing labor cost budget for the year ending December 31st 2017. This is quite straightforward, where we have to get the output units produced based on schedule 2, okay, and we also have to get the information direct manufacturing labor hours per unit, that is from table 1, okay. Let me recall the table 1. Here is the information on direct manufacturing labor for casual, and this is for deluxe, all right, 4 hours and 6 hours respectively, okay. And we have to times this figure with this, and we can get the total hours here of 240,000, okay, and this one is 60,000. So this once we calculate both of them, we add both of them, we can see that total hours is 300,000. So this 300,000 will be used as a base for our overhead calculation later on. And the hourly rate is 20, and this is also given in table 4, okay. Alright, so direct manufacturing labor as in table 4 is 20 per hour, so we have to put it here 20, and we have to times this 240,000 times 20, and we get this figure, and the total is about 6 million. Alright, here we are going to look at the step 5, where we are going to prepare the schedule 5, that is manufacturing overhead cost budget for the year ending December 31st 2017. In regard to these matters, as in the questions, they mentions, okay, if we look back at the questions, okay, there are 2 cost drivers for manufacturing overhead, that is basically direct manufacturing labor hours and setup labor hours. So in regards to manufacturing overhead cost budget in schedule 5, we also need to have 2 parts. The first one is on manufacturing operations overhead cost, alright, in response to our direct manufacturing overhead hours, as well as setup labor hours. So the second part of schedule 5, we need to have this table that is on machine setup overhead cost. Okay, we look at this one by one. As for the manufacturing operations overhead cost, it has both components that are variable costs as well as fixed costs. So in regards to fixed costs, because the information on fixed costs to support capacity of 300,000 direct manufacturing labor hours, this 300,000, the information on this is actually given to us as in this part. That is, the fixed component of manufacturing operations overhead is tied to the manufacturing capacity of 300,000 direct manufacturing labor hours. Okay, so this is clear. In regards to variable costs, we can see this information actually from our information in schedule 4. In schedule 4, before here, we already calculate that total hours is 300,000, and this is obviously must be similar, you know, it should be logical, because if the fixed cost cover the capacity of 300,000, we can calculate the variable cost for, you know, like same value, because this is actually the figures that we actually receive from this calculation in our table schedule 4. Okay, other information than that, the detail about the variable costs such as suppliers, indirect manufacturing labor, power, maintenance, and the detail for these 5 ringgit and 60, all of this information are actually an estimation by the managers, okay, from the previous year information. And this also has been mentioned in the question. If you look at the information in the questions, all right, here, the detail of the information on manufacturing operation overhead costs as well as the machine setup overhead costs in respect to Schedule 5 are actually based on the manager's estimation, and these figures are basically given by the managers. So, if we times 5 direct manufacturing labor hours times with 300,000 of the direct manufacturing labor hours, so we can get this figure 1,500,000, and same goes to other variable costs that needed in the overhead, and we can see here the total for variable costs is about 6,480,000. Same goes to the fixed costs. This information is actually given to us as in the question before, and the information in regards to the detail of the depreciation, supervision, and etc. here are also given as estimation by the managers. So we can see the total here is 2,520,000 for the fixed costs, and the total for both variable costs and fixed costs, okay, so the total is 9 million overall. So that is for the part of manufacturing operations overhead costs. Alright, so the second part is about machine setup overhead costs, because the firms, in regards to their overheads calculation, they based on these 2 cost drivers, that is manufacturing operations overhead costs as well as machine setup overhead costs. So similar to, you know, like the information before, the variable cost for 15,000 setup hours, this information actually given by us as per estimation of the managers, and the fixed cost to support capacity of 15,000 setup labor hours actually also from the questions. Okay, I recall the information from the questions given to us here. Okay, if you look at this, setup labor hours are the cost driver for the variable portion of machine setup overhead, and the fixed component of machine setup overhead is tied to the setup capacity of 15,000 setup labor hours. Okay, so here it's basically on this information. As for the variable cost of 15,000 setup labor hours, this information actually given to us as well. Alright, as in the information given here. Okay, so this information actually based on the manager's estimation of forecast for casual and deluxe in regards to the setup hours. Okay, so here basically the table, we have the information on the quantity of the table, number of batches 1 divided by 2, okay, setup time per batch as well as total setup hours. And then if we can see here, total setup hours, number of batches we divide with setup time per batch, we can see here 12,000 hours and 3,000 hours respectively, and we can get a total of 15,000. And setup per hours per table is 0.2 hours for casual and 0.3 hour for deluxe. So this is the information that we use. Okay, this 15,000, that is for the variable cost, right? So the information on suppliers or indirect manufacturing labor, power, as I said before, all this information are actually an estimation and is given by the managers in this case of these questions. Okay, so the total is 1,320,000, and the fixed cost, the information on depreciation, supervision, power are also given by the managers, and the total is 1,680,000. and we can see that if we add them both, we can get the total machine setup overhead cost is 3 million, and we add 9 million here plus 3 million here, we can get the total of 12 million of the total manufacturing overhead cost. Once we complete the table or schedule 5, we have to calculate the budgeted manufacturing operation overhead, because we want to know the price per direct manufacturing labor hour. And we also have to calculate the budgeted machine setup overhead divided with number of setup hours, because we want to know the cost per setup hour. And this information, we need to use this information in our other schedules eventually. So as you can see here, for budgeted manufacturing operations overhead, we can get just the total manufacturing operation overhead here, 9 million. We divide with 300,000 of our capacity. Okay, 300,000 of direct manufacturing labor hours, I mean that for this capacity. Okay, so we can get 30 here per direct manufacturing labor hour. As for budgeted machine setup overhead, just get the total. Okay, 3 million here, divide with our capacity of 15,000, then we can get here 200 per setup hour. Okay, so that's basically what we need to calculate for schedule 5. Thank you. Alright, now we are looking at the schedule 6.4, that is the budgeted unit cost of ending finished good inventory for December 31st, 2017. Okay, so for us to calculate the budgeted unit cost of ending finished good inventory, we need to prepare the column for cost per unit of input, as well as because this company produced 2 products that are casual and deluxe, so we need to have both tables for 2 different products, as well as the item on the input per unit of output. So what will be the quantity that we need in order for us to produce the casual table and deluxe respectively. So as for this information, you can see that the information here are basically related to red teak and granite. These are basically the direct material, and we also have direct labor, as well as the overhead, where the manufacturing operation overhead and manufacturing setup overhead is stated here clearly, right? So we need to know the cost per unit output, and basically all this information we already get from the question or given to us, as well as from other schedule. Okay, so no big deal. As for this, for example, like red teak and granite and direct manufacturing labor, this information on 7, 10, 20 is actually given to us in the questions. So if we get back to the questions, and okay, right, we can see here in table 4, okay, as in the questions, the direct teak is 7, 10, and 20 per hour for direct manufacturing labor. While for cost per input for our manufacturing operations overhead, as well as manufacturing setup overhead, this 30 and 300 is actually from our schedule 5. Okay, if you look back our schedule 5, we already calculate here budgeted manufacturing operation overhead based on the capacity. So we get here 30 per direct manufacturing labor hour, as well as for budgeted machine setup overhead, that is 3 million divided with our 15,000 of the capacity, so we can get here 200 per setup hours. So that's why we use here, okay, we use here 30 and 200 for both manufacturing operations overhead as well as manufacturing setup overhead. Okay, in regards to the input per unit of the output, Also, this information actually given to us as in table 1. So if we look back at our table 1, alright, we can see in our table 1 here 12 board feet, 6 square feet, and 4 hours for direct manufacturing for casual, and 12, 8 and 6 for deluxe. Okay, so we can just put the information here. Alright, and we just need to total them up, you know, like 7 times with 12, we got here 84, 10 times 6, we got total of 60, 20 times 4 equal to 80, similar to this, you know, like 7 times 12, we can get here 84, 10 times 8, we got here 80, 20 hours, 20 ringgit per hour, as in this case, times with 6 hours, so we got here 120. All the information here is actually about our overhead. Given that the manufacturing operations overhead, it based on, this is the cost that we calculated before, as based on the information in schedule 5. Alright, but in terms of hours, this manufacturing operations overhead is based on direct manufacturing labor hour information. So we use the direct manufacturing labor hour information as in table 1. Okay, because if we look back, direct manufacturing labor hour is the cost driver for the variable portion of manufacturing operations overhead. So as we can see, based on this information given to us, and if we check back the number of direct manufacturing hours for, as in table 1, casual need 4 hours and deluxe needs 6 hours. So that's why here, alright, here is 4 hours for casual and 6 hours for deluxe, and we just need to times this 30 times 4, we can get here 120, 30 times 6 hours, we got here 180. Okay, as for manufacturing setup, 0.2 hours and 0.3 hours, this information actually given to us based on the table. Okay, look back here, information given to us on, alright, here, estimation by managers. We already calculate that the setup hours per table is 0.2 hour for casual and 0.3 hour for deluxe. So that's why here, okay, 200 with times with 0.2 hours, we can get here 40, and 200 times with 0.3 hours for deluxe, we can get here 60, and total is 384 and 524. That is the budgeted unit cost of ending finished good inventory as for December 31st, 2017. Alright, now we look at Schedule 6B, which is related to ending inventories budget as for December 31st, 2017. So, in regards to ending inventories budget, we will look at the ending inventories for direct material as well as for finished goods. So, as for direct materials, of course, the direct materials that the company has, you can see here red teak as well as granite, and the quantity respectively are 80,000 and 200,000. And this is actually based on the information given to us in table 3. Okay, get back to table 3 where you can see here. Okay, alright, okay, 80,000 and 20,000 for granite. Alright, okay. As well as the cost per unit is 7 and 10 respectively as in table 4. Okay, this information actually given to us. We don't need to calculate for this. Okay, 7 and 10 here. And we just total them up. 80,000 times with 7, we got here 560,000, 20,000 times with 10, we got here 200,000, and the total would be 760,000. Okay, now we look at the finished goods. Obviously, for casual and deluxe, the finished goods are 11,500, as this also given to us in table 2. If you look back at table 2, this is the target ending inventory in units given to us. The information is 11,500 here for deluxe. So we just put it here in the table. And for the cost per unit, we already calculate in, like 6A table. Okay, here 384 and 524. Okay, so this 384 and 524 is actually the cost per unit. So we just put here for this information and we times this with this. We got this figure, 500 times with 524, and we got this figure, and the total ending inventory for both direct materials as well as finished goods would be 5246000. Okay, so that's basically information that we need to gather in schedule 6B. Alright, so this is supposed to be the last schedule that you have to prepare, that is schedule 7, cost of goods sold budget. Okay, so in this schedule, we normally didn't make a specific calculation. We just need to transfer some information that we get from our schedule before. Okay, so as in the cost of goods sold budget, we start with beginning finished good inventory, and then we add with direct material use, direct manufacturing labor, manufacturing overhead. Okay, and then we can get here the cost of good manufactured. Okay, and we total them up, then we can get the cost of goods sold available, where we add both cost of good manufactured together with the beginning finished good inventory that we have. Alright, and we deduct with our ending finished good inventory, and then we can get here our cost of goods sold. So that is basically the structure, and students have to memorize this kind of formula or structure. Okay, now we look at the item one by one. As for beginning finished good inventory, January 1, 2017, no big deal. This information is actually given to us as in table 2. Okay, you go to table 2. Alright, we can see here the beginning inventories in dollars. They are both 384,000 and 262,000, and if you add both of them, you can get this figure. That is the total figure for beginning finished good inventory in dollar. Okay, as in information in table 2. In regards to direct material use, we can refer back to our table 3A. Where is our table 3A? This is 3B. I'm looking for 3A. Okay. Alright. So, direct material to be used as in the table, okay, 3A that we prepared before. Here is the total of 10,280,000. Direct manufacturing labor, we get back to this 6 million in our schedule 4. Okay, so here is our schedule 4. This is the 6 million. We have to collect this information. And manufacturing overhead, the total for both that we already calculated in schedule 5. Okay, get back to our schedule 5. Here is the total of 12 million here. Alright, where you add both 9 million plus 3 million here, so the total is 12 million. Then you calculate all of this, you can get here the cost of good manufactured, and you add with 646000, you got here cost of good available for sale, that is 28926,000. And then we have to deduct the ending finished good inventory of 4486000, and this information is actually from table 6B. Alright, so be extra careful with this. We are looking for just finished good, not the direct materials, because this is the for us to prepare the cost of goods sold budget. So we just look at the finished good only. So as from table 6B, make sure that you pick the right figure. It is here, not the total ending inventory, because total ending inventory means that you consider together the direct material parts. But the fact is that for this calculation, we just take into account the finished good information only. So the total is 4486000. Alright, so after you deduct this information, this figure you deduct with 4486000, you can get here the cost of goods sold of 24,440,000. Okay.